Okay, looks like everybody's in so far, Tim. You can start when you're ready.
All right. Well, let's do it then. Good afternoon, everyone. So excited to be back for the second presentation on the ratios. So some of you were asking about the rest of the project. So starting next week's webinar, I'll start to incorporate the other areas of the project that we're going to cover. Okay, so we'll get to it. And just like last week, if you got any questions or comments or concerns, just keep them coming. Okay. I mean, even last week, David had a question about the peer numbers, and so if you have a point of clarity that you need, by all means, ask the question. Like some of you have done through this week. If you got a question and you feel more comfortable by sending me an email, do that. Okay. So whatever it is, whatever you all need from me, that's what we're gonna do. So last week we covered ratios 1 through 5. Those are all income statement based ratios. So you want to one way or another, ratios number 5, you want to get back to the income and or the expense. So for ratios 1, 2, and 3, that means you're going to get back to the rates. You can talk about balances, but we're going to get back to the rates. Ratio number 4, which is net operating expenses, whatever you do, make sure that you talk about the non-interest income. I know you'll talk about operating expenses because that's part of it, but you also want to make sure that you talk about fee income and other income. Mentioned it last week. I'll mention it here again. The NCUA calculates that ratio differently. The NCUA calculates it differently. So the NCUA doesn't take into consideration other income. So your numbers are not going to match. Now, those FPRs, those financial performance ratios, those are just meant to be checks anyway. Okay. If they're not exact, okay, if we're close, it's okay. Ratio number 10 that we're going to get to today, that's going to be another good example of you're gonna see the ratio that the NCUA has calculated. And for us, a lot of times it's hard to get down to the exact percentage, but we'll go through it. Okay. And then ratio number 5 from last week was ROA. And ROA, the one thing when you get there that you haven't talked about is the provision for loan loss. So if you feel that's had an impact on ROA, that's someplace that you can talk about it. Okay. So ratios 1 through 5, income statement based ratios, which means that the denominator, the number down on the bottom, is average assets. The number down on the bottom is average assets. Where we're going this week is we're going to ratios 6 through 10, which are the balance sheet ratios. Okay. So the first one that we're going to start with, well, let me stop before I even get into this. So you guys tell me in the chat, are there any questions over ratios 1 through 5? If there's not, tell me no. And if there is, let me know what the question is. So tell me where are we at today? No questions on ratios 1 through 5, or there are questions. Leah, I got the thumbs down. I don't know if that's good or bad. David, there you go. Still working on number 4. Okay. That's fair, and that's fine, right? So hopefully, between last week and this week, we've worked on them. Oh, there you go. Okay. Thumbs down meant that there's no questions. I got it. I'm tracking now. Thanks, Lee. I appreciate that. So okay, well, no questions on that. So let's get into ratio 6 through 10. So ratio number 6 is net worth to total assets. Now, ratios 6 through 10 are balance sheet ratios. So your denominator is going to be different than it was in ratios 1 through 5. In ratio number 6, this is net worth. So net worth is a true balance sheet ratio. And what that means, a balance sheet is like a picture. It's as of a point in time. An income statement is more like a movie. An income statement means I'm accumulating income and or expenses over a period of time, like a movie. So on a balance sheet ratio, like ratio number 6, it's net worth over total assets, not average assets. It's net worth over total assets. Okay. So you want to make sure that you have the correct denominator. Net worth over total assets. Net worth for us in credit unions is defined as regular reserves plus undivided. I'm going to type this out one time, then I'm going to shorthand it the rest of the time. Undivided earnings is what's going to give us our net worth. Okay. Now, undivided earnings, this is going to become important as you're doing the analysis. Okay. Every year on December 31st, the credit unions take net income and they close it out to undivided earnings, which I've shorthanded as UE. Okay, so December 31st, the net income that we've made year to date gets closed out to undivided earnings. So undivided earnings, by definition, is the net income that the credit union has made since inception. Undivided earnings is the net income that the credit union has made since inception. And that closing out of net income into undivided earnings is how the income statement and the balance sheet get linked. Net income getting closed out to undivided earnings is how the income statement links to the balance sheet. Now, if your net income is negative for a year, it still gets closed out to undivided earnings. Well, what happens is now instead of undivided earnings growing, undivided earnings is going to shrink. One way or another, when you start your new year, net income is going to start off as 0. Okay? Now, a great question would be, Gardner, why in the world are you talking about this? The answer is because ratio number 6 is oftentimes defined or referred to as the safety cushion for a credit union. And the reason it's a safety cushion is because if net income goes negative, I'm going to take it out of undivided earnings. So therefore, I always want to make sure that I have a certain percentage of my assets in the form of net worth, because that gives me that safety cushion that if something goes wrong, maybe it's a lot more expenses than income. That makes my net income negative. Maybe we anticipated that. Okay. Maybe we anticipated that. Maybe the board, the management team, we decided that we have too much net worth. Well, there's different ways that you can give that back to the membership. And one of the ways that you can do that is you can make investments in technology, or you can build branches, or anything else like that. Well, all those things can show an increase in expenses, which can mean a negative bottom line. Okay. So Mark's got a great question. So what's too much? Okay. And that's an age-old question. You know, I've been in the credit union movement now for 32 years. And that is truly a question that is specific to each credit. So I'll walk you guys through how we do it. here at CDC. Okay, so for us, our board of directors has always been very clear that if our net worth ratio gets above 10%, that the board will direct us, the management team, to figure out a way to give it back to the members. Now, that could be increasing our dividend rates on deposits. That could be lowering our rates on loans. Maybe we buy, invest in new technology. Maybe we just give the members a special dividend. So for us at CDC, that 10% is kind of the magic number. Now, there are other credit unions, okay, to Mark's question. There are other credit unions that they want to have 13, 14, 15% net worth. Now, typically, you find net worth ratios that are that high in credit unions that have smaller assets. And that's because if you have to charge off a $40,000 car loan, $50,000 car loan, and you're a $10 million credit union, that could have a huge hit on the bottom line. Okay, so that tends to be where you see those higher numbers for the net worth. Now, it could also be that maybe we're growing net income, but we're not growing net income as fast as we're growing assets. And if that's the case, maybe your credit union's in a growth mode. And so maybe your credit union then would be saying, well, you know what, for us, our net worth ratio, as long as it's above 8%, then we're good because we're in growth mode. But we know eventually these assets that we're growing, they're going to have to turn into income for us. And so that's how I would answer that particular question. But it's also something that you could write about in your analysis of the net worth ratio. Okay, so maybe your credit union, maybe they do have a target. Maybe it's 9%, 10%, whatever the case may be. And if that's what the credit union has, write about it. Yeah, because the way we want to approach this project, and yeah, Mark, great point. Not just for the project, but the way we want to approach this is because I'm the reader. So if Tim was going to come to your credit union and I wanted to participate in a management meeting, I would love to be able to take this report that you're putting together and be able to read it. And then next week I could come to a management meeting and participate. Doesn't mean I could do it as well as you could because you got more information, but that's giving insight. You would have to give me a lot of insights into the credit union, right? And so think about it like that when you're writing it. Are there levels, the credit union wants to be at for net worth or for any ratio? But then why? And just know that the higher the net worth gets to be, the more net income I got to generate to keep that ratio where it is. It's beyond the scope of this class, but you can take your net worth ratio multiplied by your asset growth, and that tells you what your ROA would need to be to keep the net worth ratio where you want it. Okay, so if you had, if I wanted my net worth ratio to be at 10%, and we were going to grow assets at 10%. Well, if I take the net worth of 10%, asset growth of 10%, multiply them together, that would mean that my ROA would need to be 1% to make those things happen. Okay, so the net income, it's how most of us grow capital. Now, some of you, going to be credit unions on the larger side who have issued subordinated debt, which in the credit union space we refer to this as sub debt. Subordinated debt is a way for a credit union to grow net worth. So if during the course of the project, you see your net worth ratio went from 8% to 10% in 1 year, that's probably a pretty good indication that your credit union has issued subordinated debt. And what that is you've basically gone out to other credit unions and you've offered them a personal loan, an unsecured loan where the other credit unions can invest in your credit union. Your credit union gets to put that money in the net worth section of the balance sheet. But then every quarter, your credit union pays interest on it. And so it's called subordinated because the debt is subordinated, is below regular shares. So if the credit union ever went out of business, then the net worth is going to be used to give the money back to the members first. And then if there's anything left over, it's going to be given back to the holders of the subordinated debt. Okay, so there's different things that can factor into the net worth. The same way that if your credit union has a big bump in net income in one particular year, that can cause a jump in the net worth ratio. So I bring up on the slide right here, you can see that for us at CDC, we had a big increase in our net worth from 2021 to 2022. And the reason that happened is because we sold our Class B Visa shares. So Visa, before they became a publicly traded company, used to be a co-op, and credit unions were part of that co-op. So when Visa became a publicly traded company, they had to issue restricted stock to all of the holders that were all of the members of the co-op. And so that's not publicly traded stock, but there is a secondary market for it. And so we sold ours. And that's why you see when you drop down here for us on ROA, you can see 2021, our ROA was 118 basis points. Okay. So we had a really good year, but that's because we sold that. And that's what helped increase the net worth from 9.1 to 10%. So net worth is the safety cushion. There's no doubt about that. But the reason it's a safety cushion is because of the undivided earnings. Undivided earnings is where net income gets closed out to every year before you close the books or when you close the books. If you got positive net income, undivided earnings goes up. If you got negative net income, undivided earnings goes down. That's why net worth is the safety cushion, because if net income's negative, as long as I got enough undivided earnings, we're good. Okay, so that's how you're going to calculate net worth. And again, if you have subordinated debt, you would also be a part of that. But the credit unions that are issuing subordinated debt tends to be the larger credit unions. So not everybody in the class is going to see that. But that's also one of the things that I know some of us, when we do this project, I know we go get the financials from the NCUA's FPRs and just kind of plug in numbers. But this would be a good example of I need to understand how to read a balance sheet and an income statement, a detailed balance sheet and income statement as of December 31st for whatever year I'm looking at. Okay. And again, if you want help understanding that, send me an email. Okay. Give me a call. And send me the financials and then we can go over them. Okay. So I'm here to help you guys in any way that I can. So here's what the net worth ratio has looked like for the credit union industry back here, 2008, 2009. The net worth ratios came down, and that was because of the Great Recession. And the credit union movement was the only part of the financial industry that didn't take a dime in bailouts from the federal government. And that's because we capitalized our own bailout. So what happened is the NCUA, because the corporate credit unions were having so many problems, literally sent a bill to all the credit unions and said, here's how much money you owe to create the NCUA stabilization fund. And so all the credit unions, we stroked a check to the NCUA. And so because we did that, for a lot of us, net income was negative. Well, again, net income's negative. That takes undivided earnings down. That's why the net worth ratios were going down. Now, fast forward to 2021. That's when the NCUA started to pay back the stabilization fund. So your credit union very well may have seen an increase in income because we were getting the stabilization money back from the NCUA. But for the most part, credit unions are very, very well capitalized institutions. And the reason we can be well capitalized institutions is because we don't have shareholders. If you're an investor, which is what a shareholder is, if you're an investor, you don't want the bank or the company that you're giving the money to, you don't want them sitting on it. You want them to deploy it. So that way we can make more money down the road. And so for us at credit unions, we don't have members that are asking us to do that. So therefore we can hold on to the rainy day fund, the safety cushion, because I don't have to generate returns to give back to shareholders. Okay. So we've been very well capitalized. Now I'm an old school kind of guy. Okay. So when I cut my teeth on this stuff starting 30 years ago, we referred to it as capital back then. Okay. So if you hear me say capital, equity, net worth, I'm talking about the same thing. I'm talking about the bottom part of your credit union's balance sheet. And the net worth, the capital, the equity for us in credit unions, it's made up of regular reserves and undivided earnings. Now, as you progress in your careers, there is a third area that shows up on the net worth, and that is net income YTD. Okay, net income year to date. So in other words, on your balance sheet, if you look at your credit union's balance sheets now, so we closed out August, so you would see a line item in the net worth section that says net income year to date, because we keep accumulating the net income because we don't close it out until December 31st. Okay, so just keep in mind that as you're progressing with your understanding of financial statements, what you're looking at for the project is December 31st of whatever year you're working on. If you look at that balance sheet before December 31st, there's going to be an extra line item that says net income year to date. So when you get to December 31st, net income year to date is zero because you closed it out to undivided earnings. Okay, net worth, balance sheet. So the net income year to date is just an indication of how much money we could transfer to undivided earnings at the end of the year. Okay, when you look at credit unions based on asset size, again, like I mentioned, smaller credit unions based on asset size doesn't mean that they're bad credit unions, doesn't mean that big credit unions are better. It usually comes back to that very simple principle of, hey, look, if I got to charge off a loan or I have expenses that get away from us, maybe we weren't anticipating the expenses, whatever the expenses were, maybe we were, right? So if I have a charged off loan and I'm a $10 million credit union, that could have a different financial impact. So let me just hold on to the money instead of putting it to use, okay, putting it to work. So based on asset sizes, once a credit union gets to be 200 million in assets, they're probably looking at somewhere around 9 to 10%. If your credit union is less than 200 million, then you very well may calculate a higher net worth ratio. But again, what are the conversations inside the credit? Where do we want to be? Is there a place that we want to be? Are there discussions that you become aware of that maybe we've got too much net worth? And here's how we're going to deploy that in the future. So that is ratio number 6. So again, when you look at those financial performance ratios, when you look at the operational ratios and spreads book, when you look at Callahan and Associates, you got to include the peer number. But the reason I don't want you to get caught up on peers, I know we've talked about this a little bit. The peer average from the NCUA is just based on asset size. That's it. There's nothing else to it. Okay. And so that's why I don't want you to spend a lot of time, if any, talking about why you're different than peer. It's just something for you to look at, right? And then see, well, we are different than peer. So Amy, talk about the regular reserves that are added to undivided earnings. Okay, great question. So regular reserves are statutory. Regular reserves are statutory. When you become a credit union, as your credit union grows, you're required to have so much money in regular reserves. And the reason that they're statutory is because they're required by federal law. And what that means is that you, the credit union, can't get access to the regular reserves. The regulators, the federal regulators, would have to be the ones that unlock those regular reserves. And the only reason that they would do that is if the credit union gets liquidated. So regular reserves, once they go in there, you can't touch them anymore. Which is why undivided earnings is the account that I talk about consistently when it comes to net worth, because that's the one that gets closed out to regular reserves. So another account that I could give you on the balance sheet that is driven by regulatory numbers is, some of you might have this listed different ways, but if you look on your balance sheet, you might see something that has an acronym of NCUSIF. That would be the National Credit Union Share Insurance Fund. So that is also an account that the NCUA, based on your deposit size, requires every credit union to have so much in the share insurance fund. And so they literally send you a bill. It's a blue it's a blue bill that comes from the NCUA that says, based on this call report number, your deposits were X. You need to have so much, which is Y. And then when you multiply those two things together, you need to increase your share insurance fund by X, or it's going to go down, whatever the case may be. So those are, there aren't very many examples of regulatory items on our balance sheet that are driven by the regulators, but those would be two examples. Does that help, Amy? That's a great question. Okay, cool. So and you're welcome. So ratio number 6, net worth. Okay, rainy day fund. Now, ratio number 7 is net charge-offs. Now, whenever you see the word net, that means I'm using more than one number. Okay, so net charge-offs. I'm going to put it down here in the chat. Net charge-offs is where you take charge-offs minus recoveries. Charge-offs minus recoveries is how you get net charge-offs. Now, charge-offs, that is something that can lead to an expense. Okay, so charge-offs, like income or expense, are accumulated over time. So you want to be very cognizant on ratio number 7 that when you calculate the denominator, the number down on the bottom, it's net charge-offs over average loans. Net charge-offs over average loans. And you calculate average loans the same way you calculated average assets. It's total loans from this point, from December 31st of this year, plus total loans of December 31st from last year. Add them up, divide by 2. Okay, so just make sure that you got that one dialed in. When we get to charge-offs, so charge-offs is the end of the road. So these are loans that we're not getting back. These are the loans that go to the board every month, and the board has to approve these charge-offs that we have. So charge-offs, when you see your net charge-off ratio, first of all, some of you may see a net charge-off ratio that's negative. Now, if it's negative, what would that mean? If it's negative, what does that mean? Who can tell me in the chat? If it's negative, what would that mean? There you go. Good collectors. Yeah, exactly. Yeah, you got it. You got it, Amy. Yeah. So if it's negative, if net charge-offs is negative, yeah, then you have more recoveries than charge-offs. You have more recoveries than charge-offs. Now, the reason I mention that, most years you're not going to see that. But during COVID, okay, we were at a point where courts were closed. When the courts opened up, then all of a sudden that allowed us as financial institutions to go recover bad debt. And so we saw a lot of recoveries in 2021, and the charge-offs were low because we still had stimulus payments. Okay, so some members were using those stimulus payments to make their loan payments. So that it could be, some of you might see a year where your net charge-off number is negative. Okay, but most of us, the net charge-off number is going to be quote unquote a positive number. Now, because that's understood to be an expense, that's not a number that I want to be increasing. Okay, because that's understood to be an expense, that's not something that I want to have increasing. But if you make enough consumer loans, okay, because consumer loans is where you tend to see the charge-offs. Doesn't mean that you won't see charge-offs in real estate loans, but that's rare. But if you do foreclose on a home and you have to charge off a deficiency balance, that could definitely spike your charge-off numbers for a year. Okay, so just be cognizant of that. Most of the time, charge-offs come from consumer loans. Consumer loans are car loans, personal loans, credit cards, those sorts of things. Okay, so the charge-offs tend to come from consumer loans, but if I got a real estate loan that I got to charge off, that could definitely spike my numbers. So let's look at the trend for charge-offs. Charge-offs are increasing. Why would that be? Okay, some of the things that maybe we see here is, again, 21 charge-offs were low. Now charge-offs have got on the rise again. Now, what would be some of the things that could cause that? Well, some of it might be the loans that we made back here in 22 and 23. You guys remember those car loans as well as I do, right? So there was a perceived shortage of used cars. So people were going out and paying exorbitant amounts of money for used cars. And now, we see some of those coming back to us. And if they were upside down to begin with, then that means we're going to have to charge off more. Okay, so that could be something that's contributed to it. Maybe what you see during the course of your project is something that's specific to your community happened. Military base closed down, a big employer closed down, whatever, maybe there's something like that. Maybe that's caused an increase in the charge-offs. It could also be that charge-offs sometimes increase because there's a change in management philosophy. So maybe we got a new CEO, maybe we got a new collections person who, and they're just more aggressive in charging off loans. There are some credit unions that I know personally. Once a loan gets to about 91 days, they're charging it off. Like it doesn't matter. I mean, if they get money back down the road, then that's a recovery. But once a loan gets to 91 days, it's going to the board to get charged off. For us as CDC, we tend to be a little bit more open-minded. We don't start charging loans off at 91 days, but that is where we start paying close attention. Is the member talking to us? Is the member making promises that they're following through on? If they are, then we'll keep that loan on the books. It's going to be a non-accrual status, but we're not going to charge it off. So for us, we probably have a little bit more of a conservative philosophy. We charge loans off here at CDC when we've truly gotten to the end of the road. Okay, so again, could be different reasons. As you see on this chart back here in 2008, 2009, 2010, that is when credit unions started to foreclose on homes. So we had to foreclose on homes, sell them, and that really spiked the charge-offs. So we're only about 60% of where we were at the peak back here in 2009, but the trend, okay, from history is definitely, it went way down during COVID. Again, stimulus payments might have been part of it, okay, but the bigger part of it would have been the fact that the courts were closed, so we couldn't finalize that process. So when you're doing your project, like we talked about on the first 5 ratios, don't try to focus on we were getting stimulus payments unless you're able to quantify that. If you're able to quantify, inside the credit union, we were getting so much we were getting $100,000 in stimulus payments, and 70,000 of that went towards loans. Okay, well, that's something that I could substantiate. But if we can't substantiate it, then let's stick to what we can substantiate in the project. Has there been a philosophical change? Has there been a change in policy and or procedures? Do we have? I mean, I know David was making a joke about good collections, but has the collections department grown? Has the collections department shrank? Those are the kind of things that we can talk about as from the charge-offs. We can also talk about the type of lending that we do. Maybe at Ocean Air Credit Union in California, they have a different philosophy about lending. Maybe they do more subprime lending than the University of Kentucky Credit Union does. And if so, well then, we might expect to see charge-offs at Ocean Air Credit Union, right? So there's different things that we can get into that are going to help us explain the charge-off numbers more than just members were getting stimulus payments. Okay, so net charge-offs minus recoveries. Okay, so when we look at charge-offs by credit union size, as you can see, I mean, it's fairly consistent until you get to larger credit unions. Larger credit unions tend to have a larger charge-off ratio because they get into different types of loans. It could also be that for your credit union, maybe you saw a spike in charge-offs back during COVID. There are some credit unions that decided, so there used to be a type of loan participation, and it was called a medallion loan. A medallion is what you had to have to drive a taxi cab in New York City. And those medallions were very valuable. As a matter of fact, there were 3 credit unions in New York City who were all 3 of them were over $1 billion. And their business model was to make medallion loans. And then they would participate those medallion loans out to other credit unions. When those credit unions would buy those medallion loans, they would send the cash back to the credit union. The credit union would turn around, use that cash to make more medallion loans. So that was going along real well until a disruptive force occurred on the scene. And who can tell me in the chat, what was the disruptive force? There you go, Uber, exactly. So Uber, Lyft came on the scene, and all of a sudden the value of driving a taxi cab in New York City, the value of the medallions cratered. And so those three credit unions basically went into receivership by the NCUA, and the credit unions that were holding those medallion loans, at some point, if you have a non-performing asset, you have to charge it off. At some point, if you have a non-performing asset, you have to charge it off. There are some credit unions that I know of personally that took the chance during COVID to basically just cleanse their balance sheet of the non-performing medallion loans. And so, it was done under the guise of, well, we don't really know what tomorrow is going to bring. We're in a worldwide pandemic, so we're just going to clean up the balance sheet now. So maybe that's what you see at your credit union, okay? And if so, that's okay, because that might explain if there was an increase in charge-offs at your credit union. That is what we're looking for. Just what's the explanation, okay? What is the reason that the net charge-offs went up? Okay, so different places to find them. If you want to use the spreads book as the place to get your peers, again, as you see here on the screen, it's average loans. It's average loans. So just make sure that you're not taking total loans when you're doing it. So if ratio number 7 is net charge-offs, then we get to ratios 8 and 9. So ratio 8 is delinquent loans to total loans. Charge-offs occur over a period. The accumulation of charge-offs occurs over a period of time. That's why you need average assets. Delinquencies is just as of a point in time. So because delinquencies is as of a point in time, on ratio number 8, you just need total loans, not total average loans. Okay, I'm gonna say it again. On ratio number 7, you want average loans for the net charge-offs. You want average loans. On ratio number 8, you want total loans, delinquent loans over total loans. So delinquencies are the precursor to charge-offs. Now, when you do delinquencies, when you calculate your credit union's delinquencies, you're looking for loans that are more than 60 days delinquent. The reason we don't factor in loans that are 15 days delinquent, 30 days delinquent, maybe somebody just missed a payment. And if they just missed a payment, there's not really, the loan's not really trending in a bad direction. If they've missed 2 payments, okay, now I've got a trend to talk about. And that's where the delinquent loans that are more than 60 days is what we're going to talk about during the project. Okay, so when you're making it, when we see delinquencies, again, delinquencies is a precursor to charge-offs. So the fact that we saw charge-offs increasing in those 2022, 2023, 2024, those are the kind of things that, because they were charge-offs, I would expect to also see an increase in delinquencies. And sure enough, that's what we see here. Okay, delinquencies for us as a movement have been trending up. And so what would be some of the reasons for that? Now, this is where we very well may see that there's something in the membership that hasn't necessarily triggered a charge off, but has caused members to miss payments. Maybe it's a government agency where people are going through RIFs, reduction in force. That's what a lot of federal agencies are going through now. But maybe they've gone through that after COVID. Maybe we did make a lot of indirect loans to with dealerships that didn't have the best credit scores for the people that became our members. Okay, so whatever it is, that's what you want to talk about. And again, when you get to something like this, charge-offs is the end of the road. Okay, charge-offs, there is something that happened, and I can clearly identify in those charge-offs what happened. Delinquencies is going to be a bigger pool. Delinquencies, there's more things going on. Now, I could still look at the overall pool. Maybe what I've seen is maybe we had a HELOC loan. Maybe it's been 2 HELOC loans that have gone delinquent. Well, maybe that's caused the increase in my delinquency. Maybe it's a first mortgage. Okay. Maybe that came on the books right at the end of the year. Maybe that's what caused a spike. So I can still look at the pool, but delinquencies overall is where you're going to want to look at the trend. Okay. What is it about the trend? Charge-offs, I can look and see what actually happened. Because again, we charged off that loan. The reason that loan went delinquent, maybe I got to just look at all of the loans. Okay. So delinquencies is going to be delinquencies that are more than 60 days over total loans. It's as of a point in time. But if you've never gone in and looked at an actual call report, I would encourage you to do that. If you go into the call report for your credit union, Schedule A is all of the lending information. So that's where you're going to find all of the delinquency numbers. So you can see it by different types of loans. You can see it by different time periods. So that's going to help you formulate a plan as to how am I going to articulate this. Okay, so delinquent loans to total loans is the precursor to charge-offs. So this is where, it still is pretty much uniformed. Okay, most credit unions tend to run in the 0.9 range on average for delinquencies, but there could be something that has picked up in your credit union that's caused the delinquencies to increase. Okay, so this is where you're just looking at the overall loan portfolio, delinquent loans to total loans. Now that's going to be different than when we get to ratio number 9. Ratio number 9 is one that's very, very hard for a lot of us to wrap our head around. And the reason it's hard is because it is a ratio that we don't talk a lot about inside the credit union movement. Okay, we very rarely talk about delinquent loans as a percentage of net worth. So Craig's recording this one today. So when you get to ratio number 9, come back to this part of the recording for sure. And just listen to it. Okay? Let it sink in. Let it marinate. Delinquent loans is the precursor to charge-offs. The rainy day fund is net worth. And what impacts the rainy day fund? Net income being negative, net income getting closed out to undivided earnings is what's going to impact that net worth ratio. So what's an expense that can cause my net income to go down? Charge-offs. What causes charge-offs? Delinquencies. In order for a loan to get charged off, you got to go through the delinquency process. Okay. So, my loan's got to be listed as 15 days delinquent, 30 days delinquent, 60 days, 90 days, 120 days delinquent, and then it gets charged off. So as the loans become delinquent and then they get charged off, the provision for loan loss is different than the allowance for loan loss. Okay? The provision for loan loss is different than the allowance for loan loss. The provision for loan loss is the monthly expense. When you charge a loan off, we don't need to dive real deep into the accounting aspect of this, but when you charge a loan off, the loan balance goes to zero, and the offset to that in the accounting world is your allowance for loan loss. So that means that every time you charge off a loan, the allowance comes down. Well, my allowance needs to be at a certain level. It needs to be at a certain dollar amount. Okay. So if my allowance is coming down, the way I increase the allowance is through the provision for loan loss. Okay. The provision for loan loss is the expense on the income statement that increases the allowance, which sits on the balance sheet. So if my delinquency as a percentage of net worth is growing, the trend is increasing, that means that more of my net worth has the potential to be soaked up through loans being charged off. As the percentage grows, that means that more of my net worth is exposed to these delinquent loans, and delinquent loans have the potential to get charged off. And if I charge off enough of them, that means that then my provision is going to go up because I need that expense to fund the allowance. And the allowance is what sits on the balance sheet. So ratio number 9 is where you're talking about the exposure of credit risk to the bottom line. The exposure, the credit risk, that's what delinquent loans represent. The exposure that credit risk might have to the bottom line. Now, again, the bottom line, net income doesn't show up in this ratio. But that's where, going back to what we talked about in ratio number 6, how net income gets closed out to undivided earnings, that's how delinquent loans over net worth gets to be an indication of how much exposure does my net worth have to credit risk. How much exposure does my net worth have to credit risk? So if I'm taking on credit risk, maybe it's not right now. If you guys are going to tell me in the chat, let's say I make a car loan. So David, that's a good question. I'll come back and answer that in just a second. So if I put a car loan on the books today, how long do you think it would be on the books before the loan would start to go bad? How long do you think a consumer loan would need to be, on average? How long would a consumer loan, car loan, need to be on the books before it starts to go bad? What do you guys think? And I'm not talking about fraud or anything like that. Yeah, there you go, Sarah. Yeah, so yeah, you guys got it. Yeah, about 2 years. Okay, so think about this for a second. So if I take a step back, and at Tim Gardner Federal Credit Union, we're going to start doing subprime lending today, and we're going to do as much of it as we can possibly handle. Well, for the next 2 years, I mean, I'm probably going to look pretty good, right? For the next 2 years, I'm gonna be making money, but I might not see the delinquencies show up. And then all of a sudden, 2 years from now, the delinquencies start to balloon, and then this ratio is going to grow. But really, it was 2 years ago that I started taking on the credit risk. It's just that now is when it starts to show up. Okay? Now is when it starts to show up. Okay? So we've got to be thinking about, if I see an upward trend, I'm probably going to need to go back in time to understand, well, why is that? Now, that's if the numerator is growing, if the delinquent loans are growing, then your ratio is going to grow. If net worth is going down because my net worth isn't growing fast enough, okay? So that could be another reason. I hope that's not it. But if the denominator, the number down on the bottom, gets smaller, that also, can have an impact on the ratio increasing. So back to David's question about why is this, an overlooked ratio. And in my opinion, the reason that it's overlooked is because credit unions don't start talking about credit risk until there's charge-offs. And only when there's a lot of charge-offs do they start to really concern themselves with credit risk. So this ratio, it's kind of a precursor, right? If I'm managing my credit risk, this is where it can be very helpful to see what is the peer number. Again, I'm not advocating that I want you to compare yourself to peer in the project. Don't do that. Give me the 1 year of the peer average. But here, I can kind of see, well, for other credit, so for us at CDC, we're between 200 and 500 million in assets. So I can see peer number, okay, for this point in time that I'm looking at was 3.47. So we were at 364. Before that, we had a couple of years where we were really down, but again, that was COVID. Okay, so if I look back before COVID, it looks like we were probably 2 3/4, 3%. So, maybe we are a little less than peer, but I'm right at peer. So then I can start to, maybe do some analysis on us as CDC. For us as CDC, we don't want to be at peer because our loan to share ratio isn't even close to peer. Like our loan to share ratio just now got above 40%, 40. So, for all of you out there that have a loan to share ratio greater than 8%, you're making twice as many loans as we are. So for me, seeing that we at CDC are at peer, that's very disconcerting because I know the amount of loans that our peers make, that my peers make at CDC is a lot more than us. So if this trend were to hold, this would be something that I would definitely need to go back and investigate. Now, I mean, I know what the reason is. For us at CDC, we didn't make a lot of loans, a lot of consumer loans back here, but we had one HELOC loan, and it was a big HELOC loan that was delinquent for years. Years we tried to work with this member, and he would make promises, and then he would declare bankruptcy. I mean, he declared bankruptcy, like several times over. So eventually, what we had to do was we had to foreclose on his first mortgage from the second position. And we were successful. There was a lot of strategy that went into it, but we were successful in doing that. But that for us, that's why we had this big movement up in delinquent loans overall. As you can see, our delinquencies went up, but then that caused the increase in the delinquent loans to net worth. It was one loan. We gave the member the opportunity during COVID to defer payments, and he took us up on it for sure, and then never paid us again. So I mean, I understand why the numbers move, but just looking at us compared to peer, like that's kind of scary because we don't have the same amount of consumer loans. And so when you get to ratio number 9, um, just something to think about. Okay. And again, typically you see delinquencies increase because of loans that you were making, 2 years ago, a year ago, maybe 1 to 2 years ago. Maybe we'll say it that way. Okay. So if I start to see delinquencies increase, maybe it's because of something we were doing 1 or 2 years ago. So ratio number 9, it comes back to the credit risk. How much of our safety cushion is exposed to credit risk? So I'm gonna pause right there. So ratio number 9. Does that make sense? If it does, tell me yes, and if it doesn't, tell me what the question is, or what the thought is, or what do we need to go back over? Again, it's not a ratio that we talk a lot about. It was probably, I don't even remember, 4 or 5 years ago, I guess. The leadership team of Circus wanted me to look at the 20 ratios that we calculate, because we're the management school that has the most ratios to calculate. And so I went back through all 20 of them, and I shared with the leadership team. Craig's a big part of that. Lauren, DeAngelis. I just shared with them that the ratios that we look at, they all tell different stories about the financials, both the balance sheet and the income statement. And so even though we're talking about some things that don't get a lot of run, okay? They don't get a lot of press coverage, but it's still, if I understand it, if I understand what I'm looking at, it can tell me a very important story. And so that's why we leave something in here like this. Okay. Even though a lot of credit unions don't talk about it, it's the exposure that credit risk has to the net worth, the bottom line, the rainy day fund, the safety cushion, however you want to think about it. So if I take on too much, then man, like, we got to talk about, well, how are we going to back this down? Okay. And there are things that happen. There are credit unions that, maybe they got into indirect lending, or they got with a bad dealer during indirect lending, and all of a sudden they've had to charge off a lot of loans. So then they had to back that way down. Well, that, again, it took me time to get into it. It's going to take me time to get out of it as well. Okay. So ratio number 9, delinquent loans to net worth, it has to come back to the credit risk. Credit risk, credit risk, credit risk. But you're still looking at delinquent loans that are 60 days or more delinquent. Okay, that's so what you used for ratio number 8 for those delinquent loans, you're going to use the same thing in ratio number 9, but now you're going to take the net worth from ratio number 6, and that's going to be your denominator. Okay, so it is, yeah, there you go, David. It is like turning a really big ship. Balance sheet management. It's not something that you turn quickly. You don't turn your balance sheet quickly. And so therefore, when something goes wrong, as the current and or future financial leader of the credit union, it's imperative that we all be able to explain, hey, we didn't get here overnight, and we're not going to get out of it overnight, but here is the plan to get out of it. Okay. And so taking on too much credit risk can definitely be something that sneaks up on you. Okay. Just like ratio number 10. Now, if you want to know one of the ratios that is going to take you a long time to get close to the NCUA FPRs, this is one of them. Okay. Ratio number 10, net long-term assets to total assets. Okay. Net long-term assets to total assets. So a great question would be, what in the world is net long-term assets? So here you go. So, and again, I sent the FPR cheat sheet user's guide to some of you. Craig's got it and he posted it on the LMS. But if you want a copy of it, send me an email and I'll send it to you. So when we have net long-term assets, what the way I want you to think about this, okay? So just like ratio number 9, ratio number 10, I just need you to walk down the path with me, okay? And keep asking the questions. Ratio number 9 is about the net worth that we have, or the credit risk, not the net worth, the credit risk that we have at the institution. Ratio number 10 is about the interest rate risk, which is also referred to as IRR. Okay, for accounting people, IRR can also mean an internal rate of return. But we're talking about interest rate risk. So the reason I define that is because it helps with the understanding of what this is really telling us. So interest rate risk is we've put assets on our books that we're not going to get all of the cash back anytime soon. So if I get to the point in the future, if I take on too much interest rate risk and I need cash in the future, maybe I have to go someplace else to get the cash, to raise the cash. Okay. So that's why we're looking at long-term real estate loans. For most of us, this is going to be fixed rate first mortgages. For most of us, it's going to be fixed rate first mortgages. Any long-term real estate loans that have a maturity greater than 5 years. That's the first thing. Member business loans. Member business loans have the potential to stay out there for a while. Okay. Then long-term investments. Long-term investments are any investments that have a maturity greater than 3 years. So real estate loans, it's greater than 5 years. Investments, it's greater than 3 years. The NCU SIF, the National Credit Union Share Insurance Fund deposit, when you put money into that, you can't get money out of it. Only the NCUA tells you when you can take money out of it. Okay? So the NCUSIF deposit, land and buildings. Anytime you build a branch, let's say the branch costs $5 million to build. Okay. When I build that branch, I transfer the 5 million from cash to fixed assets. When I do that, when would I get my cash back from a branch? When do you get the cash back from a branch, administrative building? Yeah, there you go, David. Yeah, when you sell it, right? So I mean, I get to, I get a little bit in depreciation every month to kind of write down the value, but the cash, the majority of the cash isn't coming back to me until I sell it. Okay. So whenever we put a fixed asset on the books, which is how we refer to land and building, whenever I put a fixed asset on the books, I got to realize I'm not getting that cash back anytime soon. Okay. You also might have other fixed assets. Fixed assets might be something like leasehold improvements. So a leasehold improvement is where you're leasing a space, and a leasehold improvement is the improvements that you make to that space. Well, that sits on my books as a fixed asset, other fixed asset, but a fixed asset nonetheless. So all these things that I just mentioned, these are cash. Cash goes out the door. It's a use of cash somehow. And we might not get this cash back anytime soon. And the reason that consumer loans, I'm gonna put it here in the chat. Consumer loans equal credit risk. Okay, consumer loans equal credit risk. If I was going to ask you guys, what's the average life of a car loan? What would you tell me? What's the average life of a car loan? There you go. Yep, you guys got it. 2 to 3 years. Okay, so 2 to 3 years is the average life of a consumer loan, car loan. And so whenever you have short-term cash flows like that, like it doesn't matter. I mean, I can make a car loan for 7 years, 8 years, doesn't matter. In 3 years, it's gonna pay off, gonna pay down. And so whenever you have short average lives, that tends to be an indication of credit risk. When you have longer term average lives, you tend to have interest rate risk. So if a car loan has an average life of 2 to 3 years, what's the average life of a 30-year fixed rate mortgage? What's the average life of a 30-year fixed rate mortgage? There you go, Sarah. Well done. 7 to 8 years. Okay. So even though we've made the loan for 30 years, 7 to 8 years, that loan's gonna pay off. That's the biggest form of prepayments on both consumer loans and on real estate loans, member business loans. It's prepayments. And prepayments is when the biggest prepayment is when somebody pays it off. Okay. So even though somebody got a 30-year fixed rate mortgage, okay, they got it. 30 years is the amortization schedule, but in 7 years, they're going to sell it. Okay. So Sarah takes out a home that she got a 30-year mortgage on, and then she becomes CEO of the credit union. So now all of a sudden she needs a bigger home on the lake, right? So she's going to sell that home, pay that one off, and then go get that big home on the lake, right? So that's how the prepayments happen. But in ratio number 10, this is cash that isn't going to come back to me anytime soon. So when I'm making this ratio, I want to be thinking about interest rate risk. If I take on too much of this, if I have too much cash that I've put out there that I got to wait a while to get back, if something happens now and I need the cash, then that could cause a problem. Now, I'm gonna walk you guys through this, because whenever you hear about a risk is a perception. What one person feels is risky, somebody else might not feel like it's that big a deal, right? So Rebecca might feel that skydiving is the craziest thing she's ever heard of in her life. She would never contemplate opening up the door of a perfectly good airplane and throwing herself out of the door, right? So then, because there's a lot of risk, because the risk is maybe the parachute doesn't open, right? And so that's too much of a risk to contemplate. So she's not going to do it. Then you have somebody like me. I have 75 skydives to my name. I find nothing wrong with opening up the door to a perfectly good airplane, as long as I got my parachute on my back, and throwing myself out of that plane. Because even though there's a risk to everything that we do, through doing it enough, understanding how many times does a parachute not open, right? So I'm playing the odds. To me, there's not that much of risk. So when somebody says you're taking on too much credit risk or you're taking on too much interest rate risk, what does that really mean? Well, if I'm gonna analyze the risk that I'm taking on, I got to know what the outcome is. If I'm taking on too much credit risk, what does that mean? Where is that really going to show up for me? As we talked about in ratio number 9, if I take on too much credit risk, that could lead to charge-offs. And the charge-offs can lead to an increase in expenses. Okay? So credit risk, if I take on too much of it, I might see an increase in charge-offs, which could affect my bottom line. Okay? Tell me in the chat, does that make sense? If I take on too much credit risk, that's the output. The outcome is that I'm going to have too many charge-offs. Okay? All right, good. So you guys got that. Now, what's the outcome to interest rate risk? So if I take on too much risk, there's got to be something, there's got to be a reason that I've taken on too much risk. Otherwise, how do I quantify? Well, I've got too much risk. I don't know if I've got too much risk until I can understand the outcome. Okay? And the outcome to interest rate risk. If you take on too much interest rate risk, then you will see, you have the potential to see an increase in your cost of funds. An increase in your cost of funds. Exactly. That's exactly right, Corey. I got to borrow money. Okay? If I run out of cash as a credit union, that means I got to go get the money because we still need cash to operate on a day-to-day basis, right? So if I got to go get the money, where am I going to go? Maybe I'm going to go to my corporate credit union. Maybe I'm going to go to the Federal Home Loan Bank. Maybe I'm going to borrow from my members, okay? And I'll take all of you back. Everybody that's here in the class today, everybody that's watching this recording, all 70 of you that were in year number 1. If you want to see what interest rate risk looks like, go back and look at your cost of funds from 2023 and 2024. If you want to know what interest rate risk really looks like, that, ladies and gentlemen, is what it looks like. Our cost of funds skyrocketed. Why did it skyrocket? Because we were making loans. Making a loan is a use of cash. We were making loans like they were going out of style. Right? You guys remember this? 2022, 2023, as credit unions, we were growing all 3 categories of loans: consumer loans, real estate loans, second mortgages, or HELOCs, right? We grew all of them. And we grew all of them. Why? Not because we're great at making loans, but because the banks stopped making loans. When the banks stopped making loans, our members just came to us because what were we doing? We were still making loans. The banks understood cash is king. So they stopped making it to hold on to their cash. We in credit unions, we didn't understand that. We kept making loans. We kept using up the cash on the asset side. And then what did we see on the liability side? We saw deposits start to flow out the door. So we ran out of cash from both sides of the balance sheet. We were making a lot of loans, and then we saw deposits flow out the door until one day we hit the panic button. Lord, have mercy. We have run out of cash, or we are running out of cash. So then what did we do? We all needed it. You guys tell me in the chat, what did we do to raise cash? There was one. Yeah, there you go, Nick. That's exactly right. We ran certificate specials. Yeah? In 2023, 2024, that's how we raised cash. We ran certificate specials at high rates. And the members loved it, right? They brought us money from other institutions. They moved money over from regular shares to the CDs to keep them there. Some of us, we went and borrowed money not only from the members with great CD rates, but some of us went out and borrowed from corporate credit unions or from the Federal Home Loan Bank. Why? Because we ran out of cash. Not because we were necessarily taking on interest rate risk, but because we were using up cash on the asset side and on the liability side. So if you want to know what the output is to interest rate risk, it's an increase in your cost of funds. It's an increase in your cost of funds. So when you calculate Ratio number 10. Okay. It's net long-term assets as a percentage of total assets. Okay. It's net long-term assets as a percentage of total assets. So the higher the number gets to be, the higher the percentage, the more chance there is that you're gonna have too much interest rate risk. Just because the percentage goes higher, it doesn't necessarily mean that you're going to run out of cash. Because think about loans. Loans amortize, meaning every month we get principal and interest from the members. Okay. So I get cash back. But if I need a lot of cash in a short period of time, that is where interest rate risk can come back to haunt us. Okay. So 2023 and 2024, it's not so much that it was interest rate risk. It was just a rapidly rising rate environment. But by definition, that's where you get into problems if you have too much interest rate risk, because I can't sell my assets. I can't raise cash fast enough. So rather than getting the cash by being able to sell investments, I got to go raise the money from the members. And so when you talk about ratio number 10, I want you to think about long-term cash flows. We at Tim Gardner Federal Credit Union have got a lot of long-term cash flows on the books. What's the strategy for that? What's the reason for that? Okay. And I'll walk you guys through a really quick example. Okay. So Tim Gardner comes into your credit union. My credit score is 830. Okay. And I make some money. So I got no problems with credit worthiness. Okay. So I'm your A+ member. So somebody tell me in the chat, if I walk into your branch today and I sit down and we're chatting and I want a car loan, tell me what the A+ car loan rate is at your credit union. Somebody give me a rate. I don't even care whose credit union it is. What's the A+ car loan rate? All right. So I got 4.5 to 5.5. Okay. So let's say 5. Okay. So I'm an A+ member. If I want a car loan, I get it at 5%. Now, I haven't left. Okay. I haven't left. But now I'm thinking, you know what? I like this credit union. Now, maybe I want to get my 30-year fixed rate mortgage from you guys, the credit union. I haven't left yet. I'm going to get my car loan at 5%. Now, what's my 30-year fixed rate mortgage rate going to be? What's that rate going to be? Somebody give me. Okay. So if I was got 7.5, okay. Now think about that. Now, even if because Rebecca was saying 6.15 for the car loan, but in this example, let's just take that. Why would I get a car loan for 6, but a real estate loan for 7.5? I haven't left. My credit worthiness, you're looking at my credit report. You're looking at my debt to income ratio, my DTI. None of that's changed. I haven't left. So why is it that the rates are different? Yeah. I mean, there's different, the cash flows have different terms, which means a different way to say that is that there's different risks, right? If you're managing Tim Gardner's credit risk, you're managing the short-term cash flows of the car loan. Because like you guys said, the car loan is going to come back in 2 to 3 years. So I'm managing the fact, is Tim's loan going to go bad in 2 to 3 years? That's the credit risk. Now, the real estate loan, now what you're managing, Tim wants a 30-year loan. So the average life to that, 7 to 8 years. Now I got to manage that. for a longer period of time. We're not worried about charging off the loan. We're not worried about that. But what we are worried about is that loan's going to be on the books for 7 to 8 years. So because of that, because the risk is different, it's a longer risk as far as the cash flows are concerned, we compensate ourselves by charging a higher rate. Okay. So again, that's a very quick example of how I haven't left a credit union, but you're going to give me 2 different rates on 2 different products. So that should be an indication. If it's 2 different rates for different products, there must be different risks that we're trying to manage. Okay. So Shiloh, is this where credit unions run into interest rate risk when they piled a bunch of super low rate 30-year fixed rate mortgages on the books? Yep. And you get too real estate heavy with long-term interest rates, with long-term money out there. Yeah. I mean, that's exactly what happened. You know, credit unions, you know, they were booking those mortgages during COVID and the interest rates were 3%. Okay. Or maybe the credit unions were selling them and then they were buying mortgage-backed securities. Okay. Like that's what happened to us. So, you know, during COVID times, the Federal Reserve said inflation is transitory, meaning that yes, there's been an increase in rates for inflation, but it'll come back down. And we envision interest rates being this low for the next 4 to 5 years. Well, at that time, we didn't make loans. We were an investment shop. They hired me at CDC Federal Credit Union because of my investment background. So, okay, well, we got money to deploy. So we bought mortgage-backed securities. We bought $130 million of mortgage-backed securities in Q4 of 2020 and Q1 of 2021. Then 2023, the interest rates got on the run in the summer of actually summer of 22. And then the value of those investments has gone down. And so even though all the investments, they work exactly like they're supposed to, we get all the cash back that we're expecting to get. It's been challenging because we haven't been able to sell those assets. So we took on interest rate risk because at the time that was the guidance, right? And so, you know, from that, what we've learned is, hey, look, I mean, the investment thing is kind of cool and all, but I'd rather figure out how to make loans. So that's what we've been doing. Let's figure out how to make loans. The loan to share ratio, which we're going to start off with next week, for us as CDC, was never above 30%. In the 78 years of CDC Federal Credit Unions, never above 30%. And now we're at 42% head and higher. Why? Because interest rate risk is a lot harder to manage than credit risk. Okay. So Shiloh, does that answer your question? That's a great question. We got a couple of minutes. So this would be true for everybody. So you cannot refer to me as Sir or Mr. Gardner. That's what my dad answers to. so it's just him. That's just how it is. So Sir and Mr. Gardner, I start looking around for Doug. Thanks, Shiloh. Appreciate that. I look around for my dad. So we got a couple of minutes. So was this okay? So Amy, if our ratio isn't matching the NCUA, what might we be missing? Any common mistakes? Typically, the common mistakes is going to be found in the fixed assets. Okay, typically. So land and building would be one place to look. I might also look at the member business loans. Okay, so those are typically the areas that I find. But get the user guide for the financial performance ratios. And again, if you've never looked at that user guide, it's going to give you a bunch of numbers and letters. Those are cells to the call report. And so when you dig into the call report, like to take Amy's question, maybe it's 2023 that the net long-term asset ratio doesn't match. So then I can go into the call report from December of 2023 and look at those different line items on the call report, those different cells, to see, well, what's driving ratio number 10. That helps me understand what I missed. So that's what I would say to that one, Amy. But if there's other ratios that you're missing, let me know. And then, okay, cool. Yeah. So I mean, other questions. Other comments. There was I know I give you guys my email address and my cell phone number, and I really mean, text me, call me, email me. When we see each other again in Circus, if you want to go over your project and you want to do it, over dinner or lunch or a drink. There were two of the students that asked me this year. They said, "Oh, well, that's really a thing. Like, we can really do that." my answer is yes. That's yes. We can do all of that. I am one of you, right? I work in a credit union, just like you guys do. Okay, there's nothing special about me. So keep the emails coming. Call me, text me, let me know how I need to communicate with you, and that's what I'll do. So Laura, the recording from last week, I think Craig put that out on the LMS. Is that
Yes,
right, Craig?
it's posted.
Okay.
I replaced the week one from last year with week one from this year.
Okay.
The recording for this one should be posted just under it in a day or two.
Okay. Cool. Thanks, Craig. So let's see. If I have a real estate non-member commercial loan, would you add this to the long-term real estate loans or the member business loans? I would add that to the member business loans. If I have non-member commercial loans, I would add that to the member business loans. Is what I would do with that. So next week, we're back to the same time that we were last week, which is 2:00 next week. It's a 2-hour window. Okay. So again, next week I'll start to sprinkle in some of the other areas of the project, as well as ratios 11 through 15. Okay. You guys are doing great. Even if you're listening to the recording and you didn't make it today, you're doing great. Just keep doing it. Right. Just keep doing it. We had 70 people that was your cohort. I want 70 people to submit their projects and come back for Circus next year. Okay. So that's all I got. Craig, you got anything else?
No, I think we've covered it all.
Good in the order? All right. Very good. Hey, look, you guys have a great week. Keep the questions coming. Let me know how I can help, and we'll pick it up same time. Close to the same time next week. All right. I'll see you guys. See you guys next week. Take care.
Another good one, Tim. See you later.
Thanks, Craig. Talk to you soon, man.